Welcome back to Trader Sage. We're going to review the ES or the MES and the MNQ um, for today, specifically September 25th. Time now is 7:33 p.m. EST. And I operate off of this quote by ICT. I'm going to paraphrase it. Treat the 4-hour as your high time frame chart and study the 5-minute structure. Honestly, I feel like the 4-hour, even utilizing ICT recommends that you still utilize the weekly chart, the daily chart, and then kind of go to the 4-hour from there. He has expressed in previous teachings as well that you can utilize in like the triple screen made popular by Alexander Elder and Trading for a Living or New Trading for a Living. The 4-hour in general is utilized or used for short-term traders. The intermediate time frame would be a higher time frame. The intermediate chart would be the 1 hour, and the short-term time frame would be the 15-minute. And honestly, how do you utilize the 4-hour to determine levels or targets inside liquidity, internal liquidity, external liquidity? You could determine the range, discount the premium, all those things on each individual time frame. But the 4-hour in general, or your high time frame chart, is going to give you the trend, right? And you want to wait for the intermediate time frame or the short-term time frame to offer you an opportunity to move in alignment with the higher time frame chart. So in this case, we have for me, just looking at it, you can just see a complete setup. And you have price, big bull bar here, climax bar, followed by a consolidation in a tight range. If you wanted to throw that out, you can. That's perfectly fine, right? You can do that, right? So price broke below the range. This consolidation offered sell side liquidity, offered some sell side, right? This is a SIBI, sell side imbalance, buy side inefficiency. So that rebalance. Listen, honestly, the terms rebalance and repricing, and I don't distinguish between the two. Not because I don't want to, but because of limited knowledge of the two. So if you know better, then do better. If it adds value to you, then keep on pushing. I just want to make that clear that if I misspoke, then I stand corrected if you have something to say about it. Anyway, so this is in and of itself is a good trade because it broke this. I think it would be easier to just restrict. Anyway, I'm gonna restrict it to just one. I think I'm gonna choose an NQ though, but this would be the target for today, and this would be the target for. This was the target previously, right here, right, and it's a target again here. I'm offering a bounce here. So why did I highlight these as opposed to anything else? Why didn't I not look for a run below this swing low? It's because price. You think in terms of discount to premium, this is now in the discount in this range here. From here to here is at a discount. The likelihood of price continue lower is still present, but the probability of it going in one shot is diminishing, right? There's ways you can look at it and determine that based off price action, but also as a model, you want to generally focus on the low-hanging fruit, right? Low-hanging fruit first. Like up here, if you took this short here, this would be your first, second, third target. Fourth target could be these swing lows or this imbalance here on this candle, on this 1800 September 17th Wednesday candle. That would be a target. And following that, you can divide this wick into levels, into quarters, or you can look at this bullish fair value gap here. And the reason for that is you can clearly see that it was used as key support here, and the bodies tell the story and the wicks do the damage, so it's still used as support here as well. So the next time that price trades into it, we want to observe, utilize our critical thinking skills, and see if price is going to react to that level. And you can still see here that price reacted to the consequent encroachment of that bullish fair value gap. I do know some people, once it's mitigated, they discard it. Good for you. That's not what I do. So that's that. So yeah, and similar here, boom, 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 boom. There's an imbalance here because it was support here. Bodies are still respecting it. The wicks is digging down into here. But if you drew that other fair value gap out, and this one seems more relevant than that one, right? Because the bodies are holding above at least the final quarter. I would say it's still holding above consequent encroachment, because it is, right? It's like once it broke up here, but it is lower than 50%. But whatever, you don't like that, then you probably can just expand the entire to incorporate the entire range, right? You can do that too. Nothing wrong with that. Let's see what that looks like. Let's not play around too much, because I don't want to make this video too long. So let's. All right. So anyway, that's that. Just wanted to point that out. I'm going to shift back to M and Q, and I'm going to stay there. Right. So I'm going to skip over the 1 hour, because I want to. I'm not going to say I don't see the relevance of it. It's there. I just don't particularly require that for my style of trading at this time. It's definitely there. The Persian revert model still works on all time frames as well. So we do have like yeah, it's not, I don't want to get too heavy. All right, so boom, right? So what's closest we see here, I'm gonna change this color because that, for me, color coded, it should be like green, and this should be red as it is. Then we have a 50%. We want to see if price retraces to at least 50% of the range, and we have that here. Kind of coinciding with the CE of this bearish fair value gap. So that's your entry. You can get in. This is a balanced price range, so you can kind of anticipate price going lower here. Here's your breaking structure. Here's another retracement into this imbalance, right? And that sends price lower again. And so, yeah, so is the 4 hour chart tradable? Sure is. It sure is. And that would be, so the turtle soup entry, you could have got in Monday, Tuesday, early morning type vibe, Monday, Tuesday. The low risk sell, it's Wednesday, London session, or the 6 a.m. candle. There's market structure shift here, and we have a retracement here into the imbalance. The bodies look like they are respecting that imbalance pretty accurately. So pretty accurately, 24,785, and the body here, 24,835, 24,783.50, and let's see what this one, and that's 24,784. So yes, everything is obviously holding below the top or the high of that fair value gap. Another key element is that once price breaks like a key level or a key swing low or swing high, you can expect some type of reaction. So this low is broken. If you want to utilize support and resistance, this low is a key level, and is a key level because it's nested, because it has a balance with it. So that's a key level as opposed to this one, right? It's below the level, below the fair value gap. This one is here. So we can, well, 24/7, 7925. But yeah, we can just shoot that across if you wanted to. But that's a key level. And that's a swing low, so we keep that red. You want to like, let's thicken that up a little, a lot, so we can't miss it. That would be Tuesday's low. And you can see here that price was not able, despite price rating this low, price retested that level, the key support and resistance level, dropped and retraced back into imbalance like we highlighted here. And that offers an intraday setup. But yeah, we could have, so far we have the high risk. We have the high risk turtle soup, call it whatever you want, high risk. I call it high risk, high reward. As you get in at the high, ooh, glorious, right? Excited. Now look at me, I picked the top. But you see everything that glow, everything that, what they say, everything that glows is not glitter, right? So that's your high risk, high reward. So it's risky, right? Like, where do you put your stop loss at? The same place you entered, pretty much, right? If you entered at the high, right? Or maybe a couple of ticks above it. It's different strategies. You can actually utilize ATR channels, for example, and just put your stop at the 3 ATR, being that we are consolidating above the 2 ATR channel. That's an opportunity. And this kind of modified MACD also offers like a opportunity here as well. We have a divergence and price going lower, but that's if you into quantitative tools. Otherwise, we can just rely on and stick to these price action based models, ICT based models. And as far as I'm concerned, whatever you can do to be profitable, that matters most, right? That nothing else really matters, right? If you can identify your edge qualitatively or quantitatively, right? Qualitatively is more so your price action based setups, your discretionary trading. There's nothing wrong with being like a hybrid, kind of utilizing indicators or technology alongside your price action analysis, right? So let's see, did that have, is there any news here? Right, so we did have news, unemployment claims during this big bear bar into this 4-hour imbalance that we highlighted before. And then you can see the reaction. And this is where we get the opportunities to execute lower time frame setups. Clearly here is a higher low. You can take that too. That's like, you know what I mean? Why not, right? So let's see something else here. Let's see if we can, that would be here. That's not what I want to do though. Sometimes identifying like the measured move is like easy, and then sometimes it's not, right? So Where is, oh, let's see what happened. So in reverse. All right, so here's your 1-to-1. Here's your measured move from here to here. That's your measured move. So up this range here, if you do here to here, obviously that's a much larger range, and we have an area of consolidation here. It also matters on how do you identify consolidations, right? Especially if you're doing like market maker buy or sell model, because honestly, these consolidation zones are resistance and support, right? Because you can say, oh, the body's respected this consolidation, retrace back into here, then violated this consolidation with force, and then now it's traded back up into this consolidation. Is it going to hold because it traded back down into this consolidation, like here to here, or there's all of this? But yeah, it's different ways. That's just how I see things as well. So doesn't mean that that's law. Doesn't mean that it's right for you. It's right for me though. So what does it matter, right? So it's one thing. So that's your high risk, high reward entry. Turtle soup. This would be your low risk, high probability entry. And it's obviously a condition to that, right? Obviously, price has already shown a willingness to go lower because boom, and you have this balance range, and boom, you can say, oh, I didn't see that. I don't accept that one. I missed it. Then here's another second stage delivery. And that's that, right? Have another low risk entry model here. As it already showed the willingness to go lower, right? And we are still from here. Let's use this from here to here. Discount as if from premium to discount. So right now in this range here, below 50%, we are at a discount now in this range. So you want to consider, oh, what type of obstacles? You could have highlighted that one. See a breakthrough or force, you kind of have more conviction to stay on it. And price continue lower, steeper discount. There's your opportunity, right? So narrative. What is the market telling you? What is the market telling you? The narrative is always where is price coming from? Where is it going? Reality. So yeah, so discount premium, you have so this is where price is coming from, and you say, okay, where's price going? Possibly somewhere below, ideally below 50%. So this kind of went below 50%, traded into here or whatever you want to do, and then retrace because it broke that key level again. Retrace back into this area. So you can kind of consider or start watching, hey, maybe price wants to continue back higher, but we don't have a upside break in market structure here. So price continues lower. And we also don't have a market structure shift here. You may see that here on the lower time frame, especially here, and then that's why you can get into like a entry here. We have this inverted fair value gap that may hold price lower. You don't use that one, you can use this bearish one here. Yeah, it's on you. You don't like that one, you can do whatever's best for you. This is the previous day's low, and this is where price is currently falling from, right? So you go here to here, then this is a premium back into discount. So you want to watch these. Well, you don't have to go over here, you can just go here. this small area here. We want to see what price does. If price does return back here, you want to see if price is going to hold that. Otherwise, price may eat this tail. And again, you want to think in terms of low-hanging fruit first, right? Low-hanging fruit first. Make your life easier. S&P Capital has this thing called easy money trades. Easy money trades that you could just you could look that up on YouTube though. But trades that you can just repeat over and over and over and over. That's literally what your edge is, right? So honestly, doing this here, this is my book of charts for the day, right? And I spent most of my time talking about the 4-hour chart. So this is more, obviously you're holding it from Tuesday. Today is Thursday. You could have held it from Tuesday or Wednesday into Thursday, right? So short-term trades, as ICT describes it, is for 1 to 2 days in general. So that's your 1 or 2 days on the 4-hour chart, right? And here is your intraday setups here. So price, what key levels? So price opened here, around here, inside the range of this previous day. So we had a retracement here, and you could have went, let's see, so this is the high, this is the low. Price stayed below, price traded back above 50%, stay below the upper third of the candle of the previous day range, drop back below. So that's your market structure shift, retrace back into this 4-hour fair value gap. And that would be, so all PD arrays on this time frame would be subordinate to the high time frame, and you can utilize that to for your bias as well, right? Because you can say price dropped below the consequent encroachment, and you can say it held below the last quarter of this 4-hour fair value gap, or you can just highlight this bearish fair value gap, or this inverted bullish fair value gap. Other than that, you have optimal trade entry utilizing the high to the low, and we have an optimal trade entry. We have an optimal trade entry here at 4 o'clock, 4:15. It just bled out. Continue to bleed out. You got your 2 standard deviations, 2.5 into the consequent encroachment of this 4-hour fair value gap. If you don't like that, then you could probably look inside way over here. And honestly, I'm not going to hold you, right? Like, you can just see. All right. I'm not going to get too crazy, but again, discount premium. But one thing is for sure, you can see here that this range here, so each one of these blue lines is the Asia range as I define it, right? Included in that is the new day opening gap. If you go further back, this delineates Sunday's price action. So right now we just retrace back into Friday's range. Let's take this off. This is getting like too noisy for me. But yes, point is that price, these consolidations, again, I ain't gonna talk too much about it, but these consolidations, especially the Asia range and the things that goes on in that defined range, that defined area, may including the midway point. Obviously it broke back below that here, and then just trying to trade it back up. But that's how I see things. It kind of makes my life easier. And what else is there? So that's the option trade entry from the London session. And there's a continuation. We had news here. Unemployment claims kind of kept price lower. It also price stayed below the previous day's low here. Kind of broke it, retested it here. Drop. Here's your low risk entry here into this bearish fair value gap, targeting the midway point here. You may have wanted to get involved with this. And remember, 35-minute market structure. You don't like that, you can go lower, right? You can keep going but you have to realize that, hey, whatever time frame you identify to trade on, that's where you are setting your targets on. Right? It's valid. All right, so here now it looks a lot different. Doesn't this look like price stab down? Look like price stab down, traded into this bearish fair value gap, stab right back down, creating a higher low, and then driving higher. All right. You can see again the bodies tell the story, the wicks do the damage, and we can do that. Why did I do that? What am I telling you? That's too dark. All right, so that's your order block. The bodies are staying above the mean threshold. That's a sign. You know, like order blocks, you don't know about order blocks, you can just miss it. You can trade the breakout from this level. But you will still have to anticipate price may want to retrace, right? But we had news here as well. Existing home sales look like moderate news, not as robust as this here, but still had a news catalyst that drove price higher. But as the model goes, the 2022 mentorship model, the fair value gap model, price runs, excuse me, price runs down like this, then you want to keep like walking down until you see a fair value gap. And there you go. So this setup would be on the 3-minute chart. It seems like you're cheating, right? But you also could think about discount premium as well here. You have here to here. Price traded above 50% into this bearish fair value gap. Drop back down into this balanced price range here. Stayed above the upper quarter of this 4-hour fair value gap. And there's your entry long. And I'm sure that would offer like an optimal trade entry, right? It's in that zone. And there's your, let's see, here's your take profit. Here's your target 1, target 2, 1 standard deviation. And it didn't go to 2 standard deviations, but that's, again, this is a 3-minute setup. And it's a 3-minute setup, so you want to choose the low-hanging fruit. That would be here. Here, you can see price consolidating above previous consolidation, like I mentioned before, kind of coinciding with this consolidation, and then push higher into another consolidation. Which is also, you can think about discounted premium. So even if you were targeting back a retracement back up here, there's no, this wick would be like, it's nothing here telling you that this wants to go, like, what is it? It can go up to here, right? And then come back down, but you want to take the low hanging fruits. And again, this setup based on this model, it came on the 3-minute chart. So AKA didn't show up on the 5-minute, this particular model didn't show up on a 15-minute. So you are choosing 3-minute targets. There you go. So even this running above this high, dropping below, have a market structure shift below these lows here, retracement into this inverted bullish fair value gap, and then short consolidation, then drop again. That's also an optimal trade entry as well. And honestly, I specialize in, that's where you have to like specialize in something. You have to find a niche, right? Here's your optimal trend entry short. Here's your 2 standard deviations. Get out. Likewise here, I expressed before, the wick is kind of long, then I kind of eliminate it. So I would still use the bottom wick because it's not as long as this one, and that would be a 2 standard deviations. But those are the type of games that I play. You may not play those games, so don't worry about it. It's not for you. It's not for you. Just leave it alone. Anyway, thanks for stopping by. Wipe your shoes at the door. Please like, comment, and subscribe. Welcome to the lab. Keep on cooking. Sometimes it's a witch's brew. Not for everybody. Probably not even for you. Sometimes you gotta leave alone your darlings. Murder your darlings, as they say. You may be holding on to something that's killing you, or killing your profitability, or killing your overall success. Just keep on keeping on. Keep on journaling. Keep on playbooking. Keep on documenting your book of charts. Stick to one setup. One setup. One setup, right? Stick to the one thing. Again, I'm currently reading. I have no affiliation with Winning in Mind. Lonnie Basham, but I really recommend that particular title if you are listening. Tune in. Stay well.